Procter Gamble. Now, this is a titan of the consumer world, right? A real bedrock in millions and millions of portfolios. But after their latest earnings report dropped, well, we've got to ask the hard questions. Is this company still forged from honest-to-goodness steel, or are we maybe looking at fool's gold?
Yeah, that's exactly it. Because when you first look at it, on the surface, the numbers look solid. They really do. But we're here to stress test the foundation. Is this a pillar of strength you can actually build a portfolio on, or is it starting to show cracks and crumble under pressure? Honestly, that is the only question that really matters to us.
And welcome to Iron Financial. Look, our mission here is really simple. We're here to help you forge a stronger portfolio. We don't mess around with hype. We don't get into wild speculation. We analyze the entire structure of a company, right from the foundation all the way up, and we cut right through the weakness. And today, Procter & Gamble is on the anvil. Okay, let's get into this.
All right, first things first, we always have to look at the top line. This is the face the company shows the world, right? It's the big headline sales number that really drives the initial story. And for their fiscal third quarter, P&G put up a number that, at first glance, looks incredibly strong.
7%. Get a load of that. Net sales are up 7% year over year to $21.2 billion. Now, you got to think about the world we're in, this macroeconomic environment, and they're up against some really tough comparisons from last year. So a 7% print for a company of this sheer scale, that's a powerful statement. It tells a story of momentum, of serious resilience. It really looks like a solid steel beam running right across the top of the entire structure.
And you can bet management is doubling down on that story. The CEO, Shailesh Jejurikar, he called it a solid acceleration. He's pointing to broad-based growth. So when you read a quote like that, you're absolutely meant to feel confident. The leadership is telling you, hey, the engine is firing on all cylinders. So, case closed, right? Easy peasy.
Whoa, hold on, not so fast. A 7% headline number is fantastic for a press release, sure. But for us here at Iron Financial, that's just the starting line. The real question, the one we need to answer, is what's underneath that shiny number. Is P&G actually selling more stuff to more people? Because that indicates true demand and real pricing power. Or are they just charging you more for the same amount of Tide and Pampers? That could just be a temporary fix, One is genuine strength. The other could just be a weakness that's being masked by inflation. We need to dig into the organic sales.
And that is a fair challenge. This is where we get to the real meat of the numbers. Okay, let's break this down. The total net sales growth of 7%, well, it gets a huge 4% boost just from favorable foreign exchange. Basically, currency fluctuations worked in their favor. So the real story, the organic growth that comes from the actual core business, is 3%. Now here's what's really interesting to me. It's how they got that 3%. It was driven by a 2% increase in volume and only a 1% increase from price. This is a critical detail. It shows us that P&G is actually selling more units. They're not just jacking up prices to create the illusion of growth. That suggests real consumer demand is there, and that is a sign of foundational strength. So yeah, on the top line, the structure holds.
All right, fine. The overall structure seems sound for now. But a skyscraper is only as strong as the sum of its parts, right? P&G isn't just one business. It's a massive collection of huge global brands. So if the company's growing at 3% organically, that's just an average. I want to know what's happening on each and every floor. Where are the real load-bearing walls, and where are the stress fractures starting to appear? It's time for a segment stress test.
Right. Let's move to the individual segments. And right away, we see that broad-based growth the CEO is talking about. Well, it isn't perfectly even. I mean, look at the absolute standout performer here, the beauty segment. Organic sales are up a massive 7%. This is being driven by some really strong performance in their premium products, things like Olay Skin Cream and some new innovations in Pantene. Then you've got Fabric and Home Care, their biggest division, home to Tide. That's holding steady at 3%, which is solid. But then you get to grooming.
Exactly. 1%. Let's be real. In the world of consumer giants, 1% organic growth is basically standing still. And you have to look closer at the language from their own report. That tiny gain came from price increases that were, and I quote, partially offset by volume declines. Let me just translate that corporate speak for you. They charged more, but they sold fewer razors. This is not a sign of strength. This is a flashing red warning light on the dashboard. You can only raise prices for so long if your customers are actually buying less of your product. This looks like a crack to me.
And this just brilliantly illustrates the entire problem. I mean, look at the left, you see all the brands we know, right? Head & Shoulders, Venus, Crest, they are absolutely iconic. But then look at the right,
you see the cold, hard data. And the data shows P&G is losing ground. Their global value share in skincare and haircare, these are key parts of that high-flying beauty segment, mind you, is down a full percentage point. And grooming? Down nearly a point as well. So while their sales in pure dollars might be going up, their actual slice of the pie is shrinking. Competitors are eating their lunch. This isn't just a small crack anymore. This is evidence of real erosion in the foundation.
Okay, so the top-line story is complicated. You've got strong overall numbers, but there are definitely signs of weakness and some pretty serious competitive pressure in key segments. So let's move down the income statement and look at the foundation of any company, its profitability. Are those sales, even with the issues in some segments, translating into strong bottom-line results? This is where we really separate the truly strong companies from the ones that are just treading water.
And what we find here is a tale of two very different metrics. Over on the left, a clear sign of strength. Core earnings per share, or EPS, is up 3%. That's the number that so often grabs the headlines. But then on the right, you see a major sign of weakness. Reported gross margin is down 150 basis points. Now, for those of you who don't know, a basis point is just 1/100%. So we're talking about a significant drop of 1.5%. And what that means is, for every single dollar of sales, P&G is keeping 1.5 cents less than they did just a year ago. That adds up fast.
And let's be perfectly clear, the EPS number is the facade. The gross margin, that's the foundation. A 3% bump in EPS can be easily engineered through things like share buybacks. It's financial engineering. But a 150 basis point drop in gross margin, that tells you there is a real brutal battle happening inside this company. It means the cost to make and sell their products is rising faster than the prices they can charge for them. The crucial point here, the thing you need to take away, is that this margin compression is where the real story is. This is the financial equivalent of testing the concrete in your foundation and finding out it's way weaker than specified.
So let's break down that pressure, because it's not one single thing. It's a multi-front war. P&G is facing a storm of headwinds right now. Just look at this. Unfavorable product mix cost them 180 basis points. All that means is that consumers are buying more of their lower-margin goods and less of the high-profit stuff. On top of that, they're reinvesting heavily in the business, which is another 100 basis point hit. Then you've got the external pressures. Tariffs are a 50 basis point hit, and rising commodity costs tacked on another 10. All told, that's a 340 basis point headwind they are fighting against. This is a massive, massive force working against their profitability.
But you have to give them credit. P&G is not just standing still and taking it. They are doing some seriously heavy lifting to fight back. Their gross productivity savings, and that's all internal cost-cutting and efficiency measures, clawed back a massive 210 basis points. That is an incredibly impressive operational feat. And on top of that, the price increases we talked about earlier added another 50 basis points to the plus side. So they're fighting a 340 basis point headwind with 260 basis points of their own effort. Now, they're still losing the battle for now, but they are putting up one hell of a fight. It shows you the company still has some serious operational muscle. Oh, they're putting up a fight, sure, but they are still going backwards on margins. And that brings us to what's always the most important part of any analysis. What does the future look like? I mean, it's one thing to fight through a tough quarter. It's another thing entirely to face a future where these headwinds actually get even stronger. So, what does management see on the horizon? Are they telling investors to brace for impact, or is this just some temporary storm they think they can ride out? Let's have a look at the guidance.
Okay, let's turn to the guidance and see how this all builds. On the surface, it looks like a show of confidence. Management maintained their full-year guidance. They're still projecting core EPS growth to be somewhere between flat and up 4%. Now, in the face of all those headwinds we just looked at, holding the line on guidance is supposed to be a signal of stability. It's supposed to tell the market, hey, we've got this under control, don't worry, the plan is working. But the devil is always in the details. Yes, they maintained the range, but then they slipped in a critical warning. You can see it right here in the quote. They now expect results to be toward the lower end of the guidance range. This is classic corporate speak, my friends. It is a soft warning. They're not officially cutting guidance because that would cause panic, but they are telling anyone who's actually listening to lower their expectations. So that 0 to 4% range is really looking more like 0 to 1%. That's not a sign of confidence. It's a quiet admission that the headwinds are winning. And they were actually very specific about why they're issuing that warning. They quantified the combined impact of all the new and existing headwinds for the rest of their fiscal year, and the total negative impact comes out to 25 cents per share. Now, for a company of this size and scale, that is a substantial number.
It is a very clear acknowledgement that these cost pressures are not just a Q3 problem. They are a significant and ongoing drag on the entire business.
And let's break down that 25-cent hit, because the numbers here are just staggering. We are talking about $150 million in after-tax headwinds just from commodity costs, a lot of that due to oil prices and disruptions from conflict in the Mideast. Then, another $400 million from tariffs. And if that wasn't enough, on top of all that, a $250 million hit from higher interest and tax expenses. These are not small, manageable numbers you can just brush aside. This is a nearly $1 billion wall of costs that they now have to climb over for the rest of the year. That's exactly what's forcing them to guide everyone to the low end.
Okay, so we've deconstructed the top line. We've stress-tested the segments, we've examined the cracks appearing in the margins, and we've looked at the path forward. Now, it is time for the verdict. We've put all the components out on the table. How do we assemble them into a final, coherent conclusion? Is this company forged steel, or is it fool's gold?
Let's just lay it all out, side by side. The bull case, what we're calling the steel frame, is built on an absolutely incredible history and just massive cash generation. I mean, 70 consecutive years of dividend increases. That is a fortress of stability. They generated $4 billion in operating cash flow this quarter alone, and they plan to pay out $10 billion in dividends this year. This company is a cash-generating machine, plain and simple. But then you've got the stress fractures, and the bear case is just as compelling. The margins are actively shrinking under immense cost pressure. They are losing market share in their most important categories to hungry competitors, and management has explicitly warned investors that results are heading toward the low end of an already uninspiring range thanks to hundreds of millions in headwinds. So the crucial point here is that while the historical frame is pure steel, there are undeniable fractures appearing under the current load.
Which leaves us with the final question you as an investor have to answer for yourself. You've got a company with what looks like an unbreakable history of rewarding shareholders, a true iron law of the market for nearly a century. But at the same time, it is facing very real, very significant, and very current challenges. So is that 70-year streak a guarantee of future stability? Or is this a classic case where the pressures of today are so great that past performance is no longer a reliable guide for the future? That's the decision you have to make. Forged steel or fool's gold? The evidence is all there. The final verdict is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.